Welcome back to the monetary policy coverage straight from the Reserve Bank headquarters. My colleague Ritu is also with us, and we have an array of guests with us. We have economists Abik Barua and Shaumikanti Ghosh. We have Neeraj Gambhir and Jairam Sridharan. We also have Srinivas Varadaraj with us, and in a bit more bankers. Gentlemen, thank you very much for your patience. Shaumya, anything extra you noticed in the press conference? In response to the answers, it at least seemed to me that the Reserve Bank is a little more worried about inflation's trajectory.
Lata, I think, thank you. I think I have a little bit different interpretation from the policy. If you very carefully look into the policy statements, the paragraph 7, paragraph 15, paragraph 30 has to be read in together. The paragraph 7, which I think was highlighted by you also earlier, is that the monetary policy was of the view. It's not says is. Was means it is related to today's policy action. So basically, whether you want to treat the glass as half empty, half full, is and was, that has to be, whether it is more holistic, that's the interpretation which has to be taken. So I think was means was for today's policy. And paragraph 15 and 30 clearly, 27 clearly says that past rate actions will also be taken into consideration. So if that is, and that is a statement which is reminiscent of the Powell statement. If that is the case, I think the RBI is fairly balanced in its assessment. Of course, the inflation remains a threat because when the February policy will be announced, the December inflation number will be on the table and it will be more than 7%. But thereafter, in April policy, it will continuously show a downward trajectory. So in my sense, I think the policy is balanced and the forward-looking statement has to be interpreted with caution because it is clearly said it will be data dependent. And since the fact is that the February policy will be data dependent in the sense that there will be a December numbers will be more than 7%. So that is open to anybody's interpretation. But in my sense, I think a distinction needs to be made between is and was, as in the paragraph 7 of the monetary policy statement.
Okay. I'll persist with that question to Abik as well. You know, when I asked him that the real positive real rate, even forward-looking, when inflation comes to 5.2, will be 1%, and do you want to go to 2% real rate? He said, no, it will be 85 basis. And it will go to 1% provided inflation is where we see it is. So it did look like they were a little cautious. Anyway, besides my observation, Abik, would you expect that there is more to come in terms of peak repo rate?
Overpass either the monetary policy statement or try to read into the governor's semantics. Perhaps you are right, but I think when a central bank says growth is resilient at the current moment, and it expresses some very deep concerns about inflation, particularly core inflation, which is more amenable to monetary policy adjustment, and the deputy governor keeps emphasizing the fact that the battle is far from over. And there is a renewed emphasis on the fact that 5 or 5.5% is not the new normal, but there is a chase to 4%. If I put all this together, my sense is that it's a little more hawkish than usual, and perhaps we'll go up to a terminal rate of 6.75%. is my sense of things. And on the liquidity front, I think the caution given to bankers to wean off their sort of habit of living with surplus liquidity is also needs to be taken seriously by bankers. Perhaps the average system liquidity levels could go down, but that's how monetary policy works. I mean, you just have to keep. The fact is that you need rates to go higher, you need demand to moderate, which would sort of then bring inflation down, which would bring your current account under control. So I see it in a very, very simplistic sort of way. Maybe I'm completely wrong, but this is what I learned in a basic textbook.
Well, Mr. Neeraj Gambhir, let me bring you in as well, because, while the stance is unchanged, Deputy Governor Michael Patra repeatedly stressed on the fact that the quantum of the rate hike has come down from 50 basis points to 35 basis points. How do you read into that? Is that an indication that, this tightening cycle is coming to an end? And what is your own sense of the peak rates in this cycle?
Yeah, thanks, Ritu. First of all, congratulations on 23rd anniversary. Wish you guys a lot many more to come. On the policy, I think it's a borderline hawkish, as Abhik said. I agree that there is more hawkishness there than market probably expected. But there is a bit of a careful balancing act as well. In my opinion, the extension of HTM to another year, the fact that they have talked about providing liquidity to the market if warranted, uh, in the post-policy conference, the mention that the worst of the inflation is behind us, and the statement that you refer to, which is to say that the rate hikes are now probably the days of 50 basis point rate hikes are behind us. I think this is all, in some senses, a careful balancing between the fact that they are still looking to sort of moderate the inflation, but they don't want the market to get spooked. So I think so to me, the messaging is that probably there is another 25 basis point rate hike in the February policy. And after that, we will see how things play out. The forward forecast of inflation is in about 5 to 5.5 range. If that range persists, then by the time we get to February, we'll see what the global situation is as well. So I think it's a bit of a data dependent, but looks like another 25 basis point is on the table as far as February policy is concerned.
Yes, RBI did stress again and again that it will remain data dependent, giving no other indication. But Jairam, let me bring you in as well. From your point of view as an NBFC, what is your sense? RBI clearly giving the comfort that they will keep liquidity ample and act as need be and remain nimble.
Ritu, I tend to agree a little bit with where Neeraj and Abhik were, that on balance, it sounded a little bit more hawkish than what one might have bargained for. Overall, it was kind of no drama. It was mostly what one expected, but some of the language, particularly in the press conference, sounded a little bit more hawkish. I do think that both on inflation and on liquidity, I know you mentioned that, I thought that some of the additional color and commentary and language that has been introduced is a little bit on the hawkish side, like the insistence that, yes, liquidity will be introduced, but only if all existing facilities are being fully utilized. That's a relatively new language. So it does look like on both inflation and liquidity, I thought things were a tiny bit more hawkish than what one had expected. On growth, I thought it was relatively neutral. And on external sector, the whole USD INR thing, which a couple of meetings ago, it was a really big conversation point. It seemed very benign. So that's the way we read it. As an NBFC, as you rightly said, for us, the rate environment in the market matters a lot. And what we are seeing and continue to see, even in these last kind of 4, 5, 6 months, is continued increase in spread over GSEC for AAA paper and for AA paper. So it looks like that will continue some more. So a week ago, 10 days ago, if you had asked me, I would have said, hey, it looks like, at about 650, we are absolutely done. So we'll probably do one more in February and done. But given some of this language, it's not super clear. It looks like it could be a little bit more than that even, and could even go to the 670-ish range that Abhik was talking about.
Okay. Well, I think the OIS market is now edged up to indicating that they are expecting even 675 as the terminal rate. So, Srinivas, your thoughts? How do you expect the spot 10-year bond yield to itself move in the remaining part of the fiscal?
Lata, at the margin, the policy was more hawkish to expectations. There were some expectations in the market that there would just be even lower than 25 basis points, which didn't kind of eventuate. But having said that, I'll come to your question on 10-year bond yields. But the way I look at policy from here on, is I agree with Neeraj. There's likely to be another 25 basis point increase in the February policy. A simple application, of a monetary policy rule with some discretion kind of calls for that, a 25 basis point increase. And I think thereafter, February will also be a good time for the RBI to revisit its stance, given the fact that real rates could begin on a forward basis, could start looking to be positive. the liquidity situation again, the excess liquidity would kind of adjust, as alluded to by the governor. And there could be a change in the stance possibly coming in February. Given that, I think, an important point this year, even as one kind of looked at the demand-supply situation, the beginning of the year, it looked pretty onerous for the market to take in the supply. But interestingly, what's happened is that if you look at the data, the total investments by banks, year to date has been about 3.5 trillion in bonds versus about close to about 1.5 trillion last year. So it's been pretty big this year. And I think in addition to demand from investors, what's also been pretty important this year has been the requirement for hedging demand from banks on the back of bond-linked derivatives, and that's been pretty significant. And estimation is that it could be close to about 1 trillion INR this year. So taking all these things into account, I think the 10-year bond yield at around should get capped around 7.5 max, 740 to 7.5, and we should then basically trade a range.
Fair enough. Take your point there that yes, there is a lot of demand for bonds from the FRA guys, the forward rate agreement guys. Jairam, not too much time, so a quick reply. Do you think that the way rates are going up and Deputy Governor Patra indicating still more worries over inflation, is there a worry at all that builders or home buyers, ability will taper off a bit because of the higher cost of money?
There is no, in the real economy level, at the ground level, Lata, we're not seeing anything like that. We are seeing really strong demand. I don't think a few more basis points here or there is going to make a big difference. Demand level, there is there isn't a worry right now at the ground. We will see as we come to Jan-Feb if there's another hike and then what happens. But right now, I'm not worried about it. I think that part of the equation will hold up really strong. As you know, credit growth in India is a 9-year high. Demand across sectors, retail, wholesale, everywhere, kind of really high. I don't see that as a major issue. Inflation, I think, is what we'll be watching a lot more.
Okay. Well, I think Abik has stayed with us for a goodish bit. Thank you very much for your time, Abik. I have one more question for you, Soumya. After all, why do you hike rates? You hike rates because you want to smother aggregate demand a bit. You want to moderate aggregate demand a bit. The RBI itself has lowered its growth forecast for this year and for the first quarter of next year. Are you changing any of your growth or even inflation forecasts? Even inflation they have raised next quarter to 5.9. Are you changing any of yours?
Yeah, Lata, thank you actually for bringing this point into consideration. I'll just take 1 second to highlight a very interesting fact. Just a fortnight back, if you remember, the RBI has said in its monthly bulletin that India was on on course for a 7% growth this fiscal. So after a fortnight, this growth has now been lowered to 6.8%. And it has clearly emphasized in the policy that monetary policy acts with variable lags, which is basically 3 quarters. So this means that given the fact that it has started to raise the rates from April onwards, taking that 40 basis point hike or in March itself, I think that 9 month comes in the 4th quarter of the current fiscal. So the RBI is cognizant that this rate transmission is finally going to have an impact on the growth outlook. So therefore, this lowering of growth. So that's the first point. The second point is that we are actually at number 6.8%. Our forecast also was at 6.8%. And regarding the inflation projections, I think the final number could be a tad lower than the RBI because, as we have been saying repeatedly, that the December peak inflation rate could be around 7.2%, which was earlier expected at 7.5%. And next year, we are still okay at 5.2%, which is the RBI projection.
Well, Abik, if you're still with us, if I could ask you, given the inflation projection and we're not coming to the 6% band until the 4th quarter and we're not, okay, Abik is not with us. Neeraj, if I may put that question to you. When do you expect this pivot to a neutral stance given this inflation trajectory where inflation is not really coming to that middle point of 4% for the foreseeable future, at least until the 2nd quarter of next year, the projections that RBI is given?
So, Ritu, the plank for a pivot has to be that we have done a significant amount of rate hikes in a very short period of time. And the market needs to absorb this at about 6.5% policy rate, or maybe 6.75 policy rate. And given the forward forecast of inflation of 5 to 5.5%, we are approximately 100 to 125 basis points higher than the inflation rate. And this is likely to restrict demand. The earliest I expect to happen is in the month of Feb to March. Between now and Feb, we will also get to see the government budget, and we will see what kind of fiscal deficit number the government is talking about. So that's also going to be an important input variable for the monetary policy. So I think that somewhere between Feb to March to April is the time when I do see some kind of a pause communication from Reserve Bank. It is not a pivot in the sense that we are not looking to see rate cuts anytime soon. We are probably going to sustain with 6.5% or thereabouts policy rate for some time, till such time the inflation does come into that 4 to 5% band.
Okay. May I attempt a rapid fire, please? Abik, who has left us, already told me that he thinks 6.75 is possible. Your peak rate, Soumya?
We are maintaining 6.25.
Okay. Neeraj?
It's 6.5 with some probability of going towards 6.75, but base case 6.5.
6.5. Okay. Srinivas?
6.5, as I said earlier, 6.5.
Okay. Oh, right. Okay. Yeah, you said that. Jainam?
6.5 with an upward bias, I think, very similar to what Neeraj said.
Okay. Okay. So there's only Soumya who still believes that possibly we have arrived. Just a word on the rupee, Neeraj. After all, the scare of the last 48 hours was there on the MPC's mind. Do you think that with the RBI stance being somewhat hawkish, the rupee is likely to be locked within 83? What's the forecast?
I think it helps rupee on the margin that the central bank is a bit more hawkish than market expected. But I think there are many variables at play. The principle being the oil prices, right? And currently we are at about $85 to $90. If we sustain in this band and the commodity prices in general sustain in the band that they are in currently, and we don't see a very significant upward bias, I think we should see rupee between 82 to 83. We will see continued presence of Reserve Bank in the market on both sides. It has been on the both sides of late. So I think that presence will kind of guide towards a gentle depreciation.
All right, Jairam, quickly before we let you go, earlier as well, some of the bankers highlighted that the cost of borrowing for corporates, that is going to get higher, and there's some worry if that may hurt some of the capex. Your thoughts quickly, because the trajectory is upwards. Most of you are penciling in at least one more rate hike, barring Soumya.
Yes, I think that is a matter of some concern. You have to say, like even in these last few months, we have seen risk spreads continue to go up, and NBFC lending, while NBFC lending, by the way, has gone up quite nicely. So banks have lent more to NBFCs in the last few months than in the months prior. But rates are going up, and the spread has increased 20 bips in the last 6 months. There is a risk that this continues, and needless to say, that's a cautionary note for NBFC sector growth and profit growth there.
Okay. Well, just one more rapid fire, if you all don't mind. Soumya, when do they change stance to neutral, you think? Next time?
Yeah, I think not before April, possibly.
Not before April. Neeraj?
Yeah, I would also agree, somewhere around April.
With April. Okay. Srinivas?
I think it could be slightly earlier in February.
Earlier. Fair enough. And Jairam?
I think March, April, and I think a reversal and a significant softening in Q3.
Okay. All right, gentlemen, thank you very much for your time and for quickly parsing the Governor's press conference and the monetary policy statement for us. The net result is very clearly obvious both in the spot yield and in the OIS yields. the market began with an expectation that it could be a 25 basis or at least 6.25 would be the last. At the moment, as you can see in our panel, probably only 1% out of 6 is expecting the Reserve Bank to stop at 6.25. The expectation is that more is coming, and clearly the tone was of a central bank which is going to go after inflation, will not be satisfied if it came to 5 to 5.4. They do want to see it moderately and gently guided towards the 4% mark. That tells you something about how the cost of capital will rise. They're also very confident of growth. If growth is good, then why should I not go after inflation? Seem to be the Reserve Bank's position. So a little bit of sacrifice of growth will perhaps be in order to get to a lower inflation trajectory. On that note, thank you very much, Neeraj, Jairam, Abhik, Shaumyo, Srinivas, for joining us and for giving us your color. Thank you very much, Ritu Singh as well. It's back to the studios. After a break, we will come back with business news.
Hello and welcome to Business Lunch. What you just saw was the backbone of CNBC-TV18 to get you the incessant coverage of business news day in, day out. 23 glorious years and still counting. And thanks to all our viewers for their support that has been coming in to give us the confidence to deliver every day. Pavitra, we are celebrating here in the studios today.
Oh, absolutely. It's complete celebration time. And you know, though we're 23 years old, and that's a long time to be up and running, we're only just getting started. So once again, thank you to all of our viewers for staying with us, for, you know, your continued support and loyalty all through the years. But for the markets right now, we are around 40 points lower on the Nifty. So that one is seeing a cut of around 0.25%. We started just at the flat line and have slipped since then. But the big policy cue, which was, you know, what the markets were really waiting for, at least, Nisha, that is out of the way now.
That's right. But inflation concerns, that is something that cracked the markets today. If you really take a look at Nifty, Sensex, SBI, all of them cracked in the same momentum. But Axis Bank as well as ICICI Bank, two outliers amongst the banking space. Let's take to the big story of the day. Infosys, 9,300 crore rupees open market buyback has opened today. And Reema Tendulkar is right here to tell us all about this. Tell us, Reema.
Thanks so much for that. So first, some details about the Infosys buyback, which is open today. It's an open market buyback. The company will buy back shares in the open market starting today for the next 6 months at a maximum price of 1850 rupees per share. The overall size is 9,300 crore. The promoters will be participating in the buyback, and this buyback is a part of the company's capital allocation plan, where the company plans to return 85% of the free cash flow from FY20 to FY24. This would be the company's fourth buyback. The previous buyback was in 2021 and of a similar size, 9,200 crore. The last three buybacks, just to give you an indication of the kind of history, have been open market buybacks. This time as well, it's been an open market buyback, so that's clearly the preferred way for the company. ICICI Securities also very recently did some interesting analysis of how the stock price of Infosys has behaved before and after the buyback, and they're saying there's no clear correlation between the price gains and the buyback announcement as per the historical data for all the tier 1 IT companies. So particularly for Infosys, let's pull up those details up, and you would see the performance has been fairly disparate, but last two times the stock actually performed well once that buyback support came in. So the stock outperformed in the last two buybacks in the 1 month post the buyback. Back to you.
All right, Reema, thanks a lot for getting us all of those details on the Infosys buyback. But with that one link, we're out of time. You know, this is what happens on policy days. But you guys stay tuned, because there's lots more news and updates that we're tracking once we come back.
CNBC-TV18, celebrating 23 years of business leadership.